Good afternoon, and welcome to Johnson Lambert's Insurance Accounting Considerations for PPP Loans, Premium Refunds, and Going Concern as a result of the pandemic. I am Dustin Barnwell. I'm a principal with Johnson Lambert. I will introduce the presenters momentarily, but before I do so, I would like to cover a few administrative items. You can download a copy of today's presentation from the Resources window. If you experience any technical difficulty during the webinar, please click on the help icon. To engage with our great presenters, please submit your questions in the Q&A window. We will do our best to answer as many of your questions during or at the end of today's session. For those interested in receiving CPE or CRE credit for participating in today's webinar, I would like to call your attention to the certificate icon. You can launch the certificate window to monitor your progress toward earning your certificate. Once you have met the criteria, you will see an image appear in the certificate window. Click on this image to download your certificate. The only way to obtain your CPE or CRE certificate is by downloading it through this platform. Credit is not available for group viewings. Johnson Lambert uses polling questions for credit verification purposes to receive your one CPE or CRE credit. For today's session, you will need to present for the full 50 minutes, be present for the full 50 minutes, and answer at a minimum of 3 of the polling questions. So without further ado, please join me in welcoming today's speakers. We have 3 of our audit partners heavily involved in our insurance practice. First, I want to welcome Lauren Darr. Lauren serves on the AICPA's NAIC task force and represents the firm at NAIC meetings. Good afternoon, Lauren.
Good afternoon, Dustin.
Next, we have Sarah McConnell. Sarah serves on the AICPA's insurance expert panel. Good afternoon, Sarah.
Hi, Dustin.
And last but not least, we have Josh Partlow. Josh is a former member of the AICPA Audit Standards Board and a current member of their Board of Examiners. Good afternoon, Josh.
Good afternoon, Dustin. Great to be here.
So before we get started, I wanted to take a moment to acknowledge the work of the many individuals across multiple industries that have and continue to provide essential services during these unprecedented times. We know there are a lot of challenges and it's very difficult. So we want to thank them for their continued hard work to help make our lives as easy as possible. We also hope that you, your families, and your coworkers are staying safe. With that, let's dive in. Today, we will address the accounting and financial reporting impacts COVID-19 has had on the insurance industry. We will focus on PPP or Paycheck Protection Program loans, premium refunds, and other payments to policyholders, as well as the disclosure requirements related to these impacts for both GAAP and statutory reporting. We will also cover considerations related to management's responsibility to evaluate going concerns. We will close with some final thoughts and answer any questions with the remaining time. So the first topic on the agenda is the Small Business Administration's Paycheck Protection Program loans. Before Sarah takes us through the accounting and reporting considerations for the PPP loans, I'd like to kick off this segment with our first polling question. Did our organization take a PPP loan, and are you planning to apply for forgiveness? Your choices are A, yes, we took a loan and plan to apply for forgiveness. B, yes, we took a loan but do not plan to apply for forgiveness. C, no. Or D, yes, but we returned all of the funds. Returned all of the, let you know that please, you have to select an option and submit your answer through the polling question and not through the Q&A window. If you do submit through the Q&A window, it does not count toward your CPE or CRE credits. So we'll give you a few more seconds to answer this polling question. All right, let's see what the results are. So it looks like we have large majority have not taken PPP loans. And then about 28% have and plan to apply for forgiveness. All right, with that, Sarah, I will turn it over to you and let you take us through the ins and outs of the PPP loan program.
Okay, thank you, Dustin. Even though only about a third of those of you in attendance today did take the PPP loan, I do think all of you will find this discussion rather interesting. As you know, the SBA put out the Paycheck Protection Program, loan program, very quickly in response to COVID-19's pandemic earlier this year. And as a result of that, then the accounting world had to respond with the accounting for PPP loans rather quickly as well. And so I do think it's interesting to learn about the different options that are available, even if your organization did not take that loan. So getting started, just a couple of reminders. Each borrower under the PPP program should determine what is going to be the best course of accounting for your organization. There's not a one-size-fits-all answer to every circumstance. The AICPA did put out 4 acceptable models to account for Paycheck Protection Program loans, and those are listed here on the screen for you. The first model is under the FASB ASC 470, the codification section on debt. The second model is FASB ASC 958-605, which is the codification section for nonprofit entities and revenue recognition. The third option is under FASB ASC 450-30, which is the contingencies gain model of the codification. And the fourth one would be under International Accounting Standards IAS 20, accounting for government grants and disclosure of government assistance. These are the four different models that are available. We're going to focus today on talking about ASC 470 debt, as well as ASC 958-605 for nonprofit accounting, as I think those are probably the 2 methods that would be most frequently used by organizations on the phone today. The contingency gain model is very similar or gets to a very similar answer as the 470 debt models. That's why we won't review that one in too much detail. And the standard setters seem to be saying that they think a lot of public companies will be using the IAS 20 method just because that more parallels what some of the PCAOB standards are. In any event, I think walking through the first 2 in detail will give you a good overview of the options that are available for you in this accounting treatment of this new loan program. So the very first option we're going to touch on is accounting for the PPP loan as debt. If you select this option, then what you're really doing is following the legal form of the PPP loan issuance, because in a sense, you got a loan and that you have a legal agreement to make an obligation or make payments on that loan or follow the terms for forgiveness as outlined in the agreement with the SBA. When you account for this as debt under ASC 470, you're going to record a liability for that debt on the balance sheet. And then you're going to recognize or de-recognize that liability when you become legally released as the primary obligor under the arrangement. So in cases where you are going to make payments on that loan and you're just going to use it as the 1% loan that was provided by the SBA, you would de-recognize the liability in accordance with the payments that you're making. And you would also accrue interest as part of that loan as well. But if you're going down the path of forgiveness, then you're going to want to make sure that you are keeping that liability on the books until you're legally released as the primary obligor. So that's going to be when the SBA releases you and provides you with the forgiveness of this debt arrangement. That legal release occurs from the SBA, does not occur from the bank. Those are 2 different steps in the process. The first is to get forgiveness from the bank, and then it gets passed on to the SBA. So it is that final release from the SBA that is required. And when that occurs, then you're going to recognize the amount of the loan plus any accrued but forgiven interest into the income statement as a gain when that debt is ultimately extinguished. For cash flow purposes, if you're doing the debt model for accounting for this, you're going to report that in the statement of cash flows, with the amounts that are borrowed under the loan being shown as a cash inflow in financing activities, and then any payments would be a cash outflow from financing activities. If you go the route of forgiveness, the amounts of principal that are forgiven would be shown as non-cash financing activities, and the interest forgiven would be shown as a reconciling item between your net income and your cash from operations. If you do the loan model of accounting, you do need to make sure that you are considering your debt covenants or other debt covenants that you may have with other types of borrowing arrangements that you have in place, because this certainly could impact those debt covenants as part of those other arrangements. And then you're going to want to make sure that you follow all of the required disclosures under ASC 470, looking at a disclosure checklist or the codification, to ensure that you've captured all of the details of the arrangement and the required disclosures around the debt accounting. So the second area we want to look at is accounting for the PPP loan as a contribution. As I mentioned earlier, this is under ASC 958-605, which is typically nonprofit revenue recognition. This is an allowable form of accounting even for organizations that are not considered nonprofit, but we'll talk about some considerations you need to make in looking at that a little bit later. But I do want to just make sure that this is there is an understanding that you don't have to be a nonprofit to follow this method, but there are some caveats to that statement that we'll touch on. If you choose to follow this method, what you're really doing is following the substance of the agreement. You're saying that I'm going to account for this as a contribution or a government grant because I think in substance, that's actually what it is. I got a grant from the government to allow me to continue my operations during the pandemic. This is going to be recorded as what's called a conditional contribution within the financial statements. So when there is a conditional contribution, you record a refundable advance as a liability on the balance sheet until the conditions have been met. There are various condition considerations that need to be made in looking at these arrangements, and there's definitely guidance that was put out by the AICPA to help evaluate what those conditions are. But in order to account for this as income, the conditions need to be substantially met based on what has taken place at the balance sheet date. And you cannot use any forecasting as part of making that decision as to whether or not something has been substantially met. So if your balance sheet date is September 30th, then you need to say, as of that date, have I satisfied the conditions within this agreement to be able to recognize this refundable advance into my income statement as a gain. So some of the conditions that are being discussed as a part of this arrangement include the full-time equivalent headcount requirement, qualified expenses. The loan is designed to only be used for certain types of expenses. There's also limitations on reductions in compensation as part of the terms of the agreement. There's also just a judgment around the eligibility of the loan as well. That could be considered a condition or a barrier as part of this arrangement. The key thing I want to emphasize here is that there's a lot more judgment that goes into accounting for a loan as a contribution, and management's going to need to make those judgments about all of these barriers that exist within the agreement, and whether or not those have been substantially met to be able to release the conditions and call this revenue. And so I do think that the documentation around this is much more detailed and onerous on management to make sure that you have met the conditions and identified all of the conditions within the agreement. If you do take the accounting for PPP loan as a contribution method, then there is still a statement of cash flow impact. The loan proceeds will be expected to be forgiven. Any loan proceeds that are expected to be forgiven get reported as operating activities. If you're not going the forgiveness route, then that becomes a financing activity. There is the option for partial derecognition of the liability. So with that refundable advance that gets recorded at the time that you enter into the loan agreement. Like I said, if you have a 9/30 year end, you could be in a situation where you may be saying that that you have met the barriers to as of that date to be able to release a portion of the liability. So perhaps you haven't incurred all of the expenses for the full amount of the loan, but there might be an ability to do a partial recognition or some sort of pro rata recognition. But there are some great resources that are available to help determine what those amounts are. The AICPA has a loan calculator tool that's free to anyone that could help you identify what that calculation then looks like for your own situations. And there's other guidance that's been put out as well. But do want to let you all know that that is an option. And then, of course, there's specific disclosure requirements with regards to ASC 958-605 that need to be required to make sure you're adjusting your accounting policies for this new accounting policy that's adopted, as well as the required disclosures for conditional contributions. And for statutory accounting, one very important note to make is that the nonprofit standard under ASC 958 and the related revenue recognition is considered not applicable GAAP for statutory accounting. So if you are reporting under statutory method of an accounting, you cannot use that method I just described with regards to conditional contributions. That's only available under GAAP. And so your debt model is really going to be the most appropriate. The debt model for statutory accounting is going to be the most appropriate model to follow, and that's under SSAP 15 in the statutory accounting standards. There are some specific disclosure requirements that go along with SSAP 15, and those are actually more detailed than the GAAP disclosures under ASC 470. So you're going to want to make sure that you've captured the appropriate disclosures in your statutory financial statements. And then I think a best practice to consider would be following the same accounting for statutory and GAAP financial statements, just to make everything easier and not cause any difference between statutory to GAAP adjustments with the accounting for these transactions. I mentioned earlier that there are some really great resources that the AICPA has put out, the loan forgiveness tool, some calculators, and some other guidance. They've done a nice job of trying to include everything in one spot, and that is available on their website without a membership if you just log in, and I think you can create an account just to access some of those tools. So with that, I think we have a polling question.
Thank you, Sarah. So our next polling question is, our organization plans to account for the PPP loan as follows: A, debt ASC 470 and or SAP 15. B, conditional contribution as a government grant under 958-605, or C, still undecided. Again, I'll give you a few seconds to answer this question. Please respond to the polling question and not in the Q&A window in order to obtain your CPE credit. A few more seconds. And we'll see what the results are. Looks like about half plan to account for it as debt. And then about a third, a little over a third are still undecided.
Great. Well, hopefully the information we provided gives you a little bit more perspective as to the different options. And of course, we're always available to assist in those decisions with you as well. A few other considerations with regards to this PPP loan program. If you have taken a loan, it's very important that you have the appropriate documentation to support the loan, including your basis for certifying the need or the eligibility for the loan that took place when you submitted the original application. You may have had additional legal analysis done as part of that, and that would be appropriate to maintain as I'm sure you are all aware, there is, the SBA has come out and said loans above $2 million will be subject to audit. And so, having all of this support not only helps you with those types of loans, but also anything below the $2 million, it just helps support all of your required financial statement disclosures, as well as the positions that you're taking in the accounting by having this documentation. You want to make sure you also have support for all of the qualifying expenses that you have identified if you're going the route of forgiveness of the loan, to make sure that you have that support in accordance with the original terms of the agreement. And then you want to make sure that you have documentation for the accounting policies that you select as part of it. There was some question when this program originally started as to whether or not the Paycheck Protection Program loans would be subject to single audit requirements, which are additional audit procedures for organizations that take government grants above a certain dollar threshold. But they have come out and said that that is not the case. So these are not going to be subject to single audit requirements. But if you did take any loans under the Economic Injury Disaster Loan Program, those would be subject to single audit requirements. So again, not the SBA PPP loans. We don't have to worry about a single audit requirement on top of other audits that may come through this. But I do think it's really important to make sure you have all the documentation, that you're talking to your accounting and auditing advisors during the planning process of your audit to make sure that you're all on the same page with regards to the accounting, and you have all the support you need to support that accounting. And some tax considerations for the PPP loans. Those are going to be considered as debt for federal income tax purposes, and the interest expense that gets associated with the loan and with the debt is considered deductible. But the IRS did put out a notice earlier this year. It's Notice 2020-32, which did state that the forgiveness of the PPP loans will not be considered taxable. So that gain or income that you're taking in through the forgiveness process is not going to be taxable income to you. However, the expenses that are used to support that loan forgiveness, so if you have certain payroll costs or rent that you're using that loan for, you cannot also take a deduction against the taxable income. So basically, they're saying you can't double dip. You can't deduct the expenses that you used for the loan and then also get that loan forgiven. A few other things to just keep in mind with that concept. There could be some timing issues that come from situations where the expenses may occur in one tax year, but the forgiveness may be the following year. I've read that the SBA has 90 days to make their forgiveness, and the banks have 60 days. So in total, we're looking at possibly 5 months from the time you apply for forgiveness to that it's been forgiven. So that certainly could lead to these timing differences that could impact the current and deferred tax provisions as of December 31st. For your calendar year-end organizations. The other thing our tax team has let us know is that the IRS may provide additional guidance with regards to PPP loans, as this program was kind of rushed out rather swiftly. I think the IRS has responded to many of the concerns, but they do think that there could be some additional guidance that comes out from the IRS. And I will also say probably from the SBA as well. So certainly stay tuned as that continues to develop, as this program is new and everybody's going through it for the first time together. And so with that, I think we will transition to talk about premium refunds.
Thank you, Sarah. Yes, so the next section is going to cover premium refunds and other payments to policyholders, and Lauren Dar is going to take us through this. Lauren? Oh, sorry, we have
Thank you, Justin.
Do you mean to go through the polling question?
Sure.
So our next polling question, our organization issued the following payments to policyholders as a result of COVID-19 decreases in activity. A, premium refund. B, premium rate reduction. C, policyholder dividend. D, more than one type of payment. So give you a moment to go through that and answer the polling question. All right, a few more seconds. let's see what our results are. So it looks like a little more than a third had premium refunds, and then below that, premium rate reduction, and then following, we have more than one type of payment. All right, Lauren, so I'll turn it back over to you.
Thank you, Justin. So at the onset of the pandemic, certain types of insurers saw reductions in activity that were expected to have a positive impact on their claims development. This was led primarily by automobile insurers whose policyholders were generally at home under stay-at-home orders in the first and second quarters of this year. Additionally, various medical professional liability carriers saw reductions in healthy patients visiting doctors during this time. As a result, some insurers sought to give back to their policyholders during this difficult time as a gesture of goodwill to their customers. Many insurance companies offered premium refunds or issued policyholder dividends to get money back into the hands of their policyholders because it's just the right thing to do. While there were coverage issues brought on by the pandemic for certain insurers, these premium refunds and other payments were viewed favorably as a direct response to support policyholders in a time of need. On top of insurer-led refunds, some state regulators required insurers to refund premiums to policyholders, including for workers' compensation coverages and automobile coverages. So some states compelled refunds to be made to policyholders as well. And now we need to account for them. So that's what I'm here to support you with today. In response to these premium changes, the NAIC SAP Working Group issued Interpretation 20-08, which covers accounting and disclosures for premium refunds, rate reductions, and dividends to policyholders. The requirements were issued in late July and are effective for second quarterly filings and through the interpretation's expiration date of January 1st, 2021. There could have been variations in how these payments were reported for the first quarter since no specific guidance was put out. However, we do expect that to even out now that this interpretation has been issued. So today I will talk you through the statutory accounting of each of the four types of payments to policyholders and the disclosures required by the interpretation. I will wrap up this discussion with disclosure requirements for GAAP reporting entities and also other premium-related topics that should be considered for 2020 year-end. First, we're going to talk about when a refund is required under the terms of an insurance policy. This would be as a result of decreased exposure, for instance, in workers' compensation insurance or with a retrospectively rated policy in which the final premium is dependent on loss development over time. These decreases in premiums are covered under the various statutory guidance detailed on this slide. None of the guidance related to decreases in exposure or level of losses has changed as a result of this interpretation. Further, premium reductions that are required under the policy terms are not subject to additional disclosures detailed in this interpretation, as there was no discretionary component to these decreases. Next, we're moving on to accounting for discretionary refunds that were not required under policy terms. And I think this is where most insurers elected to refund some premiums to policyholders. The NAIC determined that treating these payments as an offset to premium income is largely consistent with existing statutory guidance for both P&C and accident and health insurers, as well as guidance for retrospectively rated contracts. However, many insurance companies offered these payments to policyholders and disclosed to their state of domicile their intent to treat those payments as an expense before the interpretation was released publicly on June 15th of this year. So as a result, the NAIC went back to the drawing board and they carved out a limited time exception to treat certain payments to policyholders as an other underwriting expense. Insurers that took this approach stated that the refund was not directly tied to re-underwriting the policy, and it also maintained the premium tax base for both regulators and agent commissions, which they viewed as more conservative and favorable. In order to be eligible to treat a premium refund as an other underwriting expense, all of the following criteria must be met. First, the insurer is a P&C insurer who also filed policy endorsements or rate filings before June 15th, 2020. And if they express their intent to treat the payments as an other underwriting expense to their state of domicile. So all discretionary payments to policyholders, whether they are classified as premium refunds or the limited time exception payments reflected as an operating expense, are subject to the COVID-19 disclosures we will cover in a few minutes, and additional disclosures are required for limited time exception payments. We do not expect to see as many insurers using the expense accounting treatment because of the criteria limiting its use in this interpretation. So for insurers who did not meet the limited time exception payment criteria to report their payments as another underwriting expense, they may request a permitted practice from their state of domicile to use the expense treatment. If the permitted practice is granted, a reconciliation of NAIC STAP to state permitted STAP is required. The interpretation recommends breaking out the disclosure by financial statement line item impacted, as there would be no impact of the permitted practice to total net income or surplus, and because premiums are considered to be a key operating metric for insurance companies. So rather than offer a discretionary payment to policyholders, some insurers, and many of you today, filed for rate reductions on either in-force premiums or for future premiums. The interpretation clarifies that rate reductions on in-force policies should be reflected as an immediate offset to premiums, while rate reductions on renewal policies should be recognized in the premium rate charged at renewal. Since policyholders have the option to not renew their policies at expiration, the rate reductions on renewals are not recognized until the renewal policy goes into effect. Each of these types of refunds are also subject to the additional disclosures for COVID-19 related payments to policyholders. Some insurers, including mutual insurance companies and other entity types that allow policyholders to participate in profits of the company, have the ability to issue policyholder dividends. Similar to refunds required under the policy terms, there has been no change to the accounting for dividend payments as covered in SSAP number 65 for property and casualty contracts. To the extent that these dividends were inspired by COVID-19 decreases in activity, they are also subject to the additional disclosures required by the interpretation. So what are these additional disclosures? Here's the good part. The primary disclosures for all types of COVID-19 inspired payments to policyholders are to be reported in Annual Statement Note 21A for unusual and infrequent items. Insurers must aggregate all COVID-19 inspired payments to policyholders in this note and describe the accounting practice used for these payments, and also list the amount of payments by type. So that would include discretionary refunds, limited time exception payments, rate reductions, and dividends being disclosed separately. Again, refunds required under the policy terms are excluded from this disclosure. As I mentioned, the NAIC wanted to shine a spotlight on refunds that were reported as an other underwriting expense under the limited time exception in Annual Statement Note 1 due to its impact on premiums, which are a key measurement metric for insurers. In addition to the disclosures on the previous slide, entities using the limited time exception are required to state the accounting practice is a limited time exception and describe which financial line items were impacted, state the reasons why the entity elected the limited time exception, and their monetary impact on revenue and expenses. And finally, the impact of using the limited time exception on key ratios in the 5-year historical exhibit. And finally, reporting entities are required to disclose if an RBC triggering event would have occurred had the limited time exception not been used, if applicable. So that is a brief summary of the statutory reporting and disclosure requirements. On the GAAP basis of accounting, the accounting treatment for discretionary payments to policyholders was largely driven by the legal form of the payment and also by how they were referred to when discussed with regulators and with policyholders. COVID-19 inspired discretionary payments to policyholders will follow Accounting Standards Codification 220-20 for unusual or infrequently occurring items. Under that guidance, amounts are required to be either disclosed separately as a component of income from operations, gross of tax, or disclosed in the notes to the financial statements. As a result, we recommend that entities consider similar disclosures for GAAP and statutory accounting if your company reports on both bases of accounting, other than those limited time exception statutory disclosures, which are not required for GAAP purposes. So last but not least regarding premiums, the NAIC has provided relief for premium receivables and high deductible receivables from the 90-day admissibility rule with interpretation 20-02. This relief is effective through the third quarter filing and is set to expire on December 30th, 2020, and not be effective for year end. At this point, insurers should not count on having the additional flexibility at year end that they're currently having in their financial reporting for quarterly reporting. Additionally, reporting entities this year may have to do some homework on premium receivable allowances. Some state insurance regulators imposed a moratorium on canceling or non-renewing a policy based on non-payment. As a result, there could be a higher amount of non-payments on policies at the end of 2020, and insurance will need to evaluate if a credit impairment allowance is necessary, which would require write-off through the income statement. The allowance may be made on a specific identification basis when it becomes probable that a receivable will not be collected, or it can be estimated as a percentage of past due premiums. GAAP and statutory companies will need to consider the need for an allowance for premiums receivable based on current economic conditions, as that prior loss experience may not be indicative of current collectability patterns due to the global economic slowdown. We have included 2 articles related to premiums of resources for you in ON24. One covers the premium refunds and various accounting treatments that we covered today, and the second one covers the collectability and impairment considerations for insurance companies. So please take a look at those for key takeaways. And with that, I'll hand it over to Dustin.
Thank you, Lauren. So our next section is going to discuss the going concern and the evaluation of the going concern assumption. And Josh Partlow is going to take us through the ins and outs of this section. Josh?
Great. Thank you, Dustin. And I think it's safe to say that while the insurance industry has been somewhat sheltered by the pandemic, it's not entirely immune from it. And because of that, the industry is expected to see an uptick in the entities that have to consider the going concern presumption, and if that remains appropriate. Now, guidance in this area also changed back in 2016 and was brought into the accounting guidance on both a GAAP and statutory basis. Because of that, I thought it was important to take maybe the next 10 minutes or so and cover this topic in case companies find themselves in this difficult predicament at year end. And you'll see here that the GAAP guidance is actually found in AUC, the Accounting Standard Update 2014-15. It's now part of the GAAP codification. And that same guidance or very similar guidance is also found in the statutory side in SSAP number 1. And the fact that it's an accounting guidance is an important item here as well. Because it's in the accounting standards now, it provides management-specific disclosure guidance that you have to follow. And management is also responsible for performing the analysis at this point as well, not just at year end, but also at interim statements. And where certain triggers are met, disclosures are now required by those accounting standards. So let's take a quick look and dive in here into the measurement approach, which is a little different than what you may have seen the last time you looked at going concern. And it starts by defining substantial doubt. And it defines substantial doubt by saying that when an entity is probable that it'll be unable to meet its obligations as they become due for a look-forward period for 1 year from the issuance date. So issuance date is generally the audit report date or opinion date, and not the balance sheet date or reporting year-end date that was previously in the going concern standard before 2016. Now, probable here and throughout GAAP is considered to be a very high threshold, so it's equivalent to likely to occur. And while there's no bright line test in the guidance, generally correlates to a 70% or greater likelihood or confidence level. So it's higher than the more likely than not threshold that we see elsewhere within GAAP standards. I also wanted to point out here that in evaluating substantial doubt and management's plans to alleviate substantial doubt, you have to consider all relevant conditions that are known or knowable at the date of issuance. So here you have to make reasonable efforts to identify items, including subsequent events. And that's true when you look at substantial doubt and then also when you look at management's plans to alleviate substantial doubt as well. So let's dive in. This chart here walks through the substantial doubt evaluation process, and it's a two-step approach. It starts by identifying if there is substantial doubt under step 1, using that definition that we just looked at. And if substantial doubt exists, the next step is to look to management's plan to determine if management's plan alleviates the substantial doubt. It's extremely important that you look at each step separately and not just jump to management's plan and whether or not they alleviate substantial doubt. Because once you trigger substantial doubt, disclosures are required in the financial statements of management's plans. And we'll talk about the specific disclosures in a bit, but as you can see here at the bottom, once substantial doubt is triggered, there are specific disclosure requirements regarding the substantial doubt factors in management's plans. And that's not the case if you didn't trigger substantial doubt to begin with under step 1. For both steps, the depth of management's analysis will vary depending on the entity's specific fact patterns. So for profitable entities with positive cash flows and no liquidity concerns, you'll probably have a very limited consideration. But for entities where there is concern, the analysis would need to be much more substantial and may involve things like projected cash flows, management documentation of those cash flows to ensure that the company can continue to meet its obligations. For insurance entities, those cash flow analysis will not only focus on the ability to meet the current obligations, but also the ability to meet the regulatory thresholds such as minimum surplus and risk-based capital requirements. Because of the failure to meet those regulatory requirements can make it probable that regulators would act and remove the ability for management to continue to meet its obligations in the normal course of business. So let's dive a little further into step 1. And the standard actually lists out several consideration and events that companies should consider in evaluating substantial doubt. And as you can see, they're fairly generic and intended for all types of entities. So it's not really helpful for our evaluation today for insurance companies. As such, I thought it'd be helpful to flush this out a little bit, look at insurance specific and insurance industry specific factors that you'll see here on this next slide. Now, as you can see, several of these items could be triggered by the pandemic. While I encourage you to take a read through all of these, I'll not go through them in detail today, given the timing, but did want to talk through a couple of the items. I mentioned earlier the probability of regulatory action, RBC levels, minimum surplus requirements could all clearly trigger substantial doubt. Other triggers could be things like non-renewal by a key policyholder, especially in situations where an insurer has low frequency of policies. It could include things like non-renewal by a key reinsurer, either at year-end or subsequent to year-end. Significant claims activity for lines of business like business interruption or travel insurance that are particularly impacted by the pandemic are impacted twofold, because not only are the claims increasing, the premium inflows are also being impacted as well. And then the final thing that I think companies need to look at that may not be considered upfront is the ability to continue operations in a remote environment. So we currently find ourselves in this environment. We're all working from home and dealing with that. And while it's not typically the item that breaks the camel's back here, it can be a contributing factor, stalling growth if your sales force isn't able to be out there on the street, generating the cash flow needed to support operations. So just one more item to keep in mind as you're looking at these substantial doubt risk factors. So also a reminder here that it's not just the factors that are in place at year end. You have to consider future events as well. So things like declines in the investment market subsequent to year end, or non-renewals and the like that could occur at year end. You also have to consider in evaluating substantial doubt. Now, if it's determined that there is substantial doubt, you'll have disclosures, as I said earlier, but the nature of those disclosures will be dependent on whether management's plan alleviates substantial doubt or not. And in assessing management's plans, there's whether or not they're probable of mitigating substantial doubt, it's a two-part test. You first have to look at if it's probable that the plan will effectively be implemented by management in that look-forward period. And then if it's probable the plans will actually mitigate the substantial doubt in that look-forward period. And notice here, probable is used in both of these. It's that same very high or likely to occur threshold that we discussed earlier, 70% confidence level. And because of that, it's generally believed and considered in the standard that the plans would have to be approved by the board of directors and the regulators to be considered probable for this threshold. And evaluating management's plans once substantial doubt is found is extremely subjective and requires a lot of judgment and reflection from management. That's partly because it's attached to and impacted by everything that the company does as part of their plan to fix the substantial doubt. The analysis, because of that, has to adapt to those plans as the plans adapt as well. So it could include things like disposal of assets, borrowing funds, restructuring debt, recapitalization, or reducing expenses. And the timing of that all comes into place, whether or not it's probable of those events actually being able to succeed in alleviating the substantial doubt, gives a huge amount of subjectivity and judgment in that management evaluation. So management teams should be discussing this together, clearly documenting the judgment areas. I think that'll help to ensure management is on the same page and avoid fire drills as part of the year-end audit procedures or in discussions with the regulatory team as well. Once you conclude that there is substantial doubt in part one, you trigger disclosures, which is why it's important to look at each step separately. As an example, we've all seen a situation where maybe a parent company or investor puts in additional capital after year end, and often management or the audit teams jump straight to step two in the substantial doubt analysis and say, hey, this is great, substantial doubt's been alleviated. And in this situation, I typically ask my teams and clients to take a step back and go to step one and evaluate if substantial doubt was really probable or not in the first place, because it'll impact the nature of the disclosures and if the entity needs to disclose the triggering events or just focus on that capital transaction itself. If substantial doubt wasn't there and it has been alleviated, you still have to disclose the principal events or conditions that initially gave rise to that substantial doubt. So in this situation, if you concluded substantial doubt wasn't probable in the first place, you would likely focus more on disclosing the actual capital transaction, and you wouldn't have to look at those substantial doubt indicators that you would under the going concern presumption. If substantial doubt is not alleviated, the disclosure takes a step up. You both have to look at the principal events that gave rise to substantial doubt, but you also have to disclose from management's perspective that there is substantial doubt about the company's ability to continue as a going concern for that 1 year period. That would really require that early warning disclosure, and typically an emphasis of a matter paragraph would also be added in the auditor's opinion as well. So one final reminder here to keep in mind is that substantial doubt can have impacts on other areas of the financial statements as well. Statutory accounting is more prescriptive here, and we've listed out a few of the areas where the SSAP specifically refer to substantial doubt in evaluating if the asset should be admitted. While GAAP is less prescriptive, substantial doubt would likely have an impact on your assessment of the asset's realizability for things like receivables, deferred tax assets, and investments. As such, we wanted to provide a reminder here that you can look back to when you're closing your books this year. So keep an eye out for all of these items if you find yourself in an area where you're evaluating substantial doubt, even in situations where you conclude ultimately that substantial doubt either wasn't there to begin with or was alleviated. So with that, I'm going to turn it back over to Dustin for a final polling question.
Thank you, Josh. So our last polling question. Under ASU 2014-15, management is required to evaluate if there is substantial doubt regarding the entity's ability to meet its obligations for a 1 year period from A, the audit engagement letter date, B, the audit report release or opinion date, or C, the balance sheet date. We have a few moments here to answer this question.
It's a tough one. Make sure you were paying attention and not just thinking about what was in the audit standards back in the day.
All right, well, let's see how we did. So it looks like we have about 53% said the audit report, release, or opinion date. Yes, all right, and that is the correct answer. All right, so that brings us to the end of today's presentation. I know some of you submitted some questions through the Q&A platform, and I believe some of the presenters were working through getting those answered. If we did not get to your question today, then we will respond to you directly via email in the next day. So before wrapping up, I did want to share some final thoughts from us here at Johnson Lambert. You know, we understand that this has been an extremely challenging time in many ways for organizations as well as individuals on a personal level. So we encourage you to consider the topics covered today, the accounting impacts that could affect your organization. Consider those as early as possible to get ahead of things to be able to ask the right questions in order to implement the appropriate guidance or make the appropriate decisions. We also want to remind you that we're here as a resource to help answer questions or provide additional guidance. Please do not hesitate to reach out to our presenters. Their contact information will be listed on the following slide, or to a member of your engagement team with any questions you might have. Just to give you a little update on what we have coming up as far as resources and additional education. Lauren did mention a couple blogs. There's one other blog in the resource list as well, and that covers PPP loans. And Lauren mentioned the ones covering the premium refunds and policy payments or policyholder payments. And so to go over some of the webinars, there are the two top webinars. Those are actually open for registration. The first one is navigating the current state of reinsurance renewals. Next Thursday, October 22nd at 2 p.m. This session will cover the general retail and reinsurance environment. And there's a lot going on in 2020, as we all are aware. There are many factors affecting the P&C industry: political and social unrest, weather events, financial market conditions, to name a few. We'll also cover how COVID-19 is magnifying the complexity and impact on the industry. Look at industry trends, the increase in loss frequency, severity, reduction in profitability, complexity of exclusions, how this and much more can come into play on direct business and reinsurance agreements. When we're talking about the renewals of these contracts, and then also some tips for navigating the space. And then the next one is, are you poised for the workplace of the future? While most organizations have at least 6 months of virtual work environments under their belt, senior management has likely worked through the initial challenges and feels more confident about their remote or hybrid environments. But as we look forward towards the future, these hybrid environments seem like they're here to stay. So the strategy needs to really shift from surviving this environment to really thriving in this environment. So that webcast will really cover that topic in more depth to kind of help make those decisions going forward, and talk about the controls over change management in regards to that. So you can register for these webinars by going to our website. And also the final two are just our annual insurance industry updates from the GAAP and the STAT perspective. GAAP being held December 10th, and STAT is scheduled for January 12th. So be on the lookout for those emails. And if you haven't done so, please go to our website and subscribe to our email list, and those will give you receive emails for industry updates as well as webinar registrations. And here's the contact information for our presenters. Please again reach out with any questions you have, and please do connect with us. We're also on these listed social media platforms. We always want to connect with the folks in the industry and answer any questions and be a resource, for anything that comes up with you all. With that, I'd like to thank you for attending, and please stay safe.